this slide, I think, could happen quite quickly. I mean, once the credit bubble bursts, I've got people who sort of, seem to have been very successful in terms of, reading cycles and things like that. And I think we're looking at March next year, ultimately. But I wouldn't be surprised if it happens before then. The only way you can get out of this, basically, is get the hell out of credit. It's really dangerous now. Get out of credit, which means getting into real money, which is metallic money with no counterparty, and it is final settlement for all credit, and that is gold.
Alasdair Macleod warns that the global fiat system is nearing collapse as debt becomes unsustainable. The U.S. Treasury is increasingly relying on short-term T-bills, effectively printing money and tightening liquidity. With no buyers for long-term bonds, the Fed is forced to halt quantitative tightening and resume QE, mirroring Germany's 1920s monetary spiral. He argues this is the largest credit bubble in history, inflated by margin debt and speculative excess, including cryptocurrencies like Bitcoin, which now mirror tech stocks. When the bubble bursts, the Fed and Treasury will attempt to rescue banks and zombie corporations, but this will only debase the dollar further. Macleod believes the stock market remains unaware of the risk, mistaking temporary liquidity for stability. He sees all fiat currencies in a race to the bottom, predicting an inevitable crash where real assets, especially gold, will be the only refuge as the dollar's purchasing power collapses.
Looking at the DXY breaking 100, it's a race to the bottom. Mm-hmm. I mean, basically, what of the major currencies, constituents of the DXY, would you buy or sell? It's immaterial. Really what's happening is that the whole of the fiat currency system is coming to an end. And we're seeing evidence of this. Every fiat currency system comes to an end because of the accumulation of debt. And that's basically what we have at the moment, Danny. It's got to the point where it's not sustainable. If you look at what the US Treasury is doing, it's funding itself out of T-bills. It really is. The problem is there's no market on the long end of the yield curve. So they can't actually go out and replace maturing long-dated stock with more long-dated stock. In other words, ensuring that the annual rollover, if you like, of debt is contained. No, they're replacing long-dated with T-bills. I mean, that's where the market is. But what it does mean is, in effect, the US Treasury is printing money. I know it's using Fed dollars for it, but it's printing money because T-bills are near cash. If the other side of the balance sheet is near cash, then you can see what's happening. It's leading to, a certain amount of liquidity problems, because if the government, if the Treasury doesn't spend this money, and at the moment, the major parts of the government are suspended, then it accumulates in the general account. So it goes out of circulation. So it doesn't go back into bank balance sheets, if you like. Mm-hmm. So on that basis, you can see that, this is tightening the system. On top of that, we had QT, which was also tightening the system. And this is why the Fed has stopped doing QT and will reintroduce from this month, next month, whenever, quantitative easing. But that, again, is printing money. So, we're on a printing credit roundabout now. How else can we print it? Well, let's find another way of doing it. That's where they are. And this is roughly where Germany was, I think, in the very early 20s, 21, early 22. And we know what then happened. And we can see how it's going to happen here too, because when the credit bubble bursts, and the credit bubble will burst, this is the biggest credit bubble in history. And on top of that, it's looking so much like 1929 with Trump's tariffs on top, replicating Smoot-Hawley and all the rest of it. When it bursts, what it's going to mean is that the Fed and the Treasury will stand by to rescue the entire banking system and also all the major zombie corporations in the US economy. They have to do it because of the unemployment mandate, if you like. And of course, the Fed is also seeing in its beige book signs that the economy is falling over, toppling, if you like, stagnating, however you like to put it, turning down. So this is a time of maximum risk. Now, at the moment, I don't think that the stock market really realizes this, but there will come a point when it does. But for now, I think with extra QE coming in, the if you like, the tightness in credit markets being alleviated, it could well feed into yet higher equities in the very short term. Because, what this credit has been doing is it's just been puffing up equity markets. It's been angled at financial markets. Just look at the level of margin debt. I mean, the level of margin debt is over 1.1 trillion, having risen over the last 10 years from about 300 billion. And that is financing stock positions. We can guess roughly 3 times that. So when this bubble pops, the banks will be foreclosing as quickly as they can, which of course will drive the market down even more rapidly. And the interesting thing is watching Bitcoin, because Bitcoin basically is a tech stock with no assets, no earnings, but just the vibes, if you like. And you can see that it correlates so closely with the Magnificent Seven. Magnificent Seven go up, it goes up. Magnificent Seven goes down, it goes down. So what's it doing now? I mean, Bitcoin basically is threatening to break out on the downside. It's dipped below its 250-day moving average, and I suspect that if it breaks that $100 level, the $100,000 level, you will see an avalanche of selling. There are an awful lot of people long of Bitcoin who are just in there for profits. I mean, we get from the sailors of this world this sort of wonderful stuff about how it's going to go to the moon and so on and so forth, but people are in it not because they think it's the new gold. I mean, that's for the fairies. They're in it basically because they want to make money, and they think it's an easy way of making money. You get this at the top of every credit bubble. And what the whole of the crypto market is telling us is just that. We are at the top of the bubble. And there's an awful lot of leverage in it too. And that, incidentally, is not in the FINRA statistics. I don't know how much leverage there is. But this is a global problem. Things are going to turn sour. Now, it's always impossible to pick the exact top in a credit bubble, and you can be wrong for 10, 15, 20% easily, even though you've analyzed it correctly. So I think I'm not prepared to say that we are actually at the top and all the rest of it, but I'm seeing a few things breaking down. And we know we've got the liquidity crunch, and we know that what the Fed is in effect doing is moving from targeting inflation to supporting the economy and ensuring that it's got enough liquidity. That is bound to undermine the purchasing power of the dollar. So, okay, it's 100, but also at the same time, I mean, this is the king rat of currencies. Other currencies are in exactly the same boat. It's just a question of who goes down fastest. And at the moment, it's not quite the dollar. The dollar might win that race to the bottom shortly afterwards. I don't know.
Alasdair Macleod warns that the financial system is under severe strain, with major bankers like Dimon and Morgan Stanley turning bullish on gold, signals that insiders see serious risks ahead. Liquidity is tightening as deposits vanish, echoing the 2019 repo crisis, and the Fed faces pressure to intervene. He argues we've reached the peak of a massive credit bubble. When it bursts, the Fed and U.S. government will be forced to keep the show on the road by printing even more money, mirroring Germany's 1920s hyperinflation. Unlike the 1930s, bankruptcies won't wipe out debt today. Credit's value will instead collapse through currency devaluation. Macleod believes fiat currencies are now in their final stage. As confidence erodes, the purchasing power of the dollar will plunge, leaving gold as the only real money without counterparty risk. He doubts the U.S. truly holds its reported gold reserves and sees the dollar's credibility unraveling. While the Fed may temporarily stabilize markets, he expects a rapid collapse of the fiat system, possibly as soon as early next year, followed by a shift toward a gold-backed currency as the only path to restore trust and stability.
But the thing that's interesting is that these, with the system under strain, I guess this is why people like Dimon are saying gold's going higher, and why Morgan Stanley sort of turn around and say you should put 20% of your portfolio into gold. Now, that's an extreme statement, a very extreme statement. But I think that the really senior bankers see these dangers. They must be concerned about it. And I think that they would have told the Fed, look, you can't go on tightening like this. We're losing deposits which are going into the general account, and we're not seeing it come out the other side. We are under strain. You carry on this way, you're going to see the same sort of thing we had in September 2019. You may remember when the repo rate suddenly shot up to about 9%, and the Fed had to come in and sort it out. But we're not far from that sort of thing happening. I mean, it is tight, very, very tight. But where does this take us? Well, the thing that's absolutely clear is that if we can look through the top of the credit bubble, when it starts going down, Danny, you will see inevitably the duty, if you like, of the Fed and the US government basically is to keep the show on the road. And how do they do it? They would just accelerate the printing presses. What did they do in Germany in 1922? Accelerated the printing presses. We have exactly the same situation. And on top of that, we can superimpose our lessons from 1929 to 1932. The difference is that in those days, businesses went bust because the dollar was on a gold standard. And the only way in which credit got wiped out was by debtors going bankrupt. And the debtors included something like 10,000 banks. They went bust and didn't honor their deposits. Today, of course, you don't have that. So where is the strain? What happens? How do you reduce the amount of outstanding credit? Well, you don't reduce the amount of outstanding credit, but what you do is you reduce its value. Its value contracts, collapses even. And that's the way in which this is going to work. And the value of credit collapsing starts with the currencies. Currencies will go down. And unless the political class actually wake up to this, and unless their advisors get off all this macroeconomic rubbish and actually begin to apply proper classical economic lessons and inform the politicians of that reality, then there is no way that the fall in the purchasing power of these currencies is going to stop. That's what's required. We've got to go back onto a gold standard. In effect, do you see that? No, I don't see that. And I certainly don't think that 8,130 tons allegedly in the coffers of the US Treasury are there. I don't think they're there. I think there's a big shortfall. So you've got a credibility problem, which is being well aired, and it's well aired even by people like Scott Bessent. Guess what? As soon as he becomes Treasury Secretary and he gets his feet under the desk in the Treasury Department, what happens? He is told, don't say anything about gold. Stumm. Don't talk about it. Why? Well, I can see two reasons why. Firstly, they are in denial about gold because they have been promoting the dollar as gold's substitute, if you like. It's a dollar standard around the world. And the second thing is a lot of that gold, I think, went out. It was leased and never came back. You open Fort Knox, I think someone rather cleverly said, you find a whole bunch of IOUs sitting there. We don't know whether this is really true because, of course, we can only surmise. But intellectually and practically, I think it's going to be extremely difficult for the mighty dollar to if you like, get away from its total collapse. So that's what we face. I mean, this is a very serious time. We are in a sort of, if you like, in an intermediate stage where, the Fed is trying to put some liquidity back into the system because it sees the danger. It's been told the danger by its intelligence in the commercial banking network. That will give us a little bit of relief. It might even puff equities even higher. I don't know. But the only way you can get out of this, basically, is get the hell out of credit. It's really dangerous now. Get out of credit, which means getting into real money, which is metallic money with no counterparty, and it is final settlement for all credit, and that is gold. Well, it's impossible to say how long the final collapse of the dollar will happen, and you never know. I may be wrong. You could find that the authorities turn around and actually do something sensible, like secure the value of the dollar somehow. I mean, there may be some sort of fiddle they can do and all the rest of it. I mean, people have been talking about a reset for ages. it's not a reset. It's just to try and secure the value of the dollar. The only way that can be done ultimately is basically by going on to a gold standard. This slide, I think, could happen quite quickly. I mean, once the credit bubble bursts, I've got people who sort of, seem to have been very successful in terms of, reading cycles and things like that. And I think we're looking at March next year, ultimately. But I wouldn't be surprised if it happens before then. When that happens, basically, you should already be completely out of credit, because the collapse, I think, will be really quite rapid from that point. And they will obviously try and do what they can to stop it and all the rest of it, but it's just going to undermine the purchasing power of the dollar. So in terms of time, I don't think we're far away from the end of the fiat currency system. And the point about being close to the end of the fiat currency system is that we're close to it, fiat currencies not being there. Now, either they're replaced by something else like a new gold-backed currency or whatever, or they tie it to gold, and incidentally have to take the economic actions to ensure that it sticks. We're nowhere near that. Nowhere near that. I don't know. I just sort of feel that we are actually moving more rapidly than we think towards the endgame of fiat currencies.
In this video, Alasdair Macleod warns that the global financial system is nearing breaking point. Big players like Dimon and Morgan Stanley are quietly turning to gold as they see severe stress in the banking system. Liquidity is drying up, echoing the 2019 repo crisis, and the Fed is being forced to pump money back in just to keep things afloat. Macleod explains that we're at the peak of the credit bubble. Once it bursts, the Fed will have no choice but to accelerate money printing, destroying the dollar's value. He believes fiat currencies are in their final stage and that gold will once again become the only trusted form of money. Backhand Index Pointing writes, stay informed, hit like, drop your comments below, and subscribe to Investo Time for more deep dives on gold, silver, and the coming financial reset.